Hey everyone, for today's episode I'm going to do this one podcast style, so there won't be a bunch of pop-ups and not a lot of stuff on the screen. So just sit back, relax, and listen and learn. Lately I've been asked repeatedly lots of questions from newer investors about 1031 exchanges. Now in case you don't know what that is, I'm going to do a deep, detailed introduction, and I promise you that in about 10 minutes you'll have a pretty solid grasp on the fundamentals of 1031 exchanges. Basically, 1031 exchanges allow someone selling business or investment property to avoid paying taxes on profits from the sale. Instead of receiving cash for the sale, the exchange value is put towards buying a new property, as long as all the necessary rules of the exchange are followed. So with the 1031, it's like you're just continuing the investment in the original property. Pretty impressive, right? Now, before you choose whether to do an exchange, it's always a good idea to get a sense of how much tax you would be expected to pay. Basically, capital gains are determined by subtracting the amount you paid when you bought your property from the amount you sell it for. I have some examples written down. So let's say Shelly bought an apartment building in Minnesota for $100,000 back in 2016. That's what we call her cost basis. If she sold it for $250,000 in 2022, her capital gain would be $150,000. Shelly could also add in the value of any improvements she made during her time as the owner, which would lower her recognized capital gain. Now, without getting into the details of the math for this episode, Shelly's normal total tax liability on the sale of her building is about $40,700. If Shelly would like to invest the $40,700 she would have paid in taxes into buying new real estate, she has the ability to delay the tax liability that would have come with it. However, when she sells that property she got from the exchange at a later date, she will have to pay the original $40,700 plus any taxes that were accrued while owning the new property. The only exception to this rule is that in the case of the exchanger's death, their heirs will be given what we call a step up in basis, which would effectively wipe out the original deferred taxes. Now, the next question you may be asking yourself is, can I only perform the exchange one time? The answer is no. You can keep taking the gains you make and roll them over into the next property or properties. This is how to build wealth for you and your family by leveraging your assets to the fullest. Let's talk about the intermediary. So what is the role of the intermediary in the 1031 process? Most commonly, this type of exchange is done through a forward or delayed exchange with a qualified intermediary or QI to facilitate the process. This person cannot be the taxpayer or someone who is otherwise excluded by law. In order for the exchange to be valid, the intermediary must enter into a written contract with the seller, acquire the relinquished property, transfer it, and acquire the replacement property and then transfer that back to the seller. Additionally, a reverse exchange may be viable if the replacement property must be acquired before the relinquished property is sold, which is becoming increasingly common in today's real estate market. Now, you have to keep in mind that a 1031 exchange has a few timing and identification requirements. Number one, you have to identify replacement property within 45 days from when you close the sale of your old property. And number two, you've got a total of 180 days from the date of closing of the old property until you have to acquire or close on the replacement property. That's 135 days from the identification deadline, those 45 days we talked about. So you can identify up to 3 potential replacement properties and then close on one of them. If you wish to identify more than 3, that's totally possible as long as the combined fair market value of all identified properties doesn't exceed 200% of the value for the old property. So let's say, for example, if Shelly's property was valued at $250,000, the combined value of 4 or more properties couldn't be greater than $500,000. Just be sure to keep the 200% rule. If you go over, you'll need to close on 90% of the value of all the identified properties, which in most cases will mean all of them. When exchanging one property for another, they must be like-kind to each other. That basically means any kind of real estate, as long as you intend to hold it as a business or an investment. For example, let's say Shelly again could switch an apartment building that she owns in Minnesota for an office building in Portland, or maybe a beachfront condo in Maui, or even some ranch land in Montana. On top of that, You can also exchange one property for several, or the other way around. If you're an exchanger looking to acquire an interest in a multi-member LLC or other partnership that owns real estate as part of the exchange, I'm sorry to say that interests in an equity do not qualify for exchange treatment, even if it is a special purpose entity that owns the real estate. All right, however, exchange treatment can be obtained with a tenancy in common or other fractional interest in real estate, including an interest in a Delaware statutory trust, as long as the replacement property is real estate, or other interests that qualifies as like kind, such as a leasehold interest of 30 years or more. Unfortunately, vacation homes and primary residences don't work for this exchange, though there are a few exceptions. The good news is vacant land that you're holding onto for appreciation, that's without getting income, is okay. As far as rent to family members goes, if the rent is lower than the fair market value, you may run into some issues. Lastly, acquisition and immediate sale of property, also known as flipping a property, is not eligible under 1031. So you are probably wondering now, how long does one have to hold one of these properties to receive the 1031 treatment? It's not set in stone, so the answer ultimately depends on the situation. Generally speaking, 2 years is usually enough. However, someone can prove their intention when they first acquired it. A shorter amount of time can qualify. For example, if someone entered into a 5-year commercial lease with a replacement tenant property soon after acquisition and then got a great cash offer due to property appreciation after a year, they could be given an exception. It's important to remember that the person or business doing the exchanging has to be the same on both properties, even if they don't actually appear on the deed. Again, for example, so the taxpayer may be the owner of a living trust, a land trust, or maybe a single member LLC, which are all disregarded entities as far as taxes are concerned. This means that even though they may be useful in estate planning or asset protection, the IRS treats them as if they don't exist when it comes to your 1031 taxes. Now, if you want to guarantee that you won't pay any taxes on the money you make from selling your current property, you need to make sure that the value of the replacement property is equal to or greater than the value of the sold. That also means if you paid off a mortgage on the original property, you'll need to take one out on the replacement property or kick in some cash. Anything either paid off or taken in outside of new debt or new cash is known as a cash boot or a mortgage boot. An exchanger is allowed to cash out some of the value from the sold property, but you should be aware that you'll be taxed with the first 25% being in the form of depreciation recapture tax. That's just the first 25%. Okay, so there's the really quick 30,000 foot view of how 1031 exchanges work. If you have any more in-depth questions, I would recommend consulting your tax advisor, as this is really their realm of expertise. Well, I hope you now have a basic understanding of how 1031 exchanges work. And if you have any questions about 1031s or anything else, please feel free to contact me anytime. And if you would like to see or hear more great content like this, please hit the like and subscribe buttons below. I'd really appreciate it. Thanks for tuning in, and I'll see you next time.